Sajiv Dhawan is now joining us this morning. Sajiv, good morning. What do you make of the global meltdown that we've seen so far? Do you think it's back to the 2008 crisis? Do you think China can become the next Lehman?
I don't think so. I think that was a very different situation with the whole banking system around the world in a state of panic. You've not seen people withdrawing money from banks. Yes, markets, commodities, equities across the board have all been falling, but there will be comparisons, obviously, because of the way the human sentiment and psychology is, that there's a panic, there's a crisis, and trying to justify a reason for it and say that what happened then is similar to what's happening now. But I don't think so. In some stage, this uncertainty will calm down. It might take a few weeks, it might take a month or two more, but it will calm down. We had the Greek crisis, which dragged on for over a year, and no one talks about that anymore. So we've just moved to another issue. Yes, China is certainly a very huge issue. It's a cause of great concern, and global markets, and India especially, have fallen off quite sharply from their highs. The opportunity is always there for investors and patient contrarians to use these opportunities, and there will be talk of the Nifty slipping maybe to 7,000, 7,200 levels. If you're talking about levels below that, then that's a real crisis of confidence and a complete panic mode, as one large bank has already pointed out. But history has shown that in times of such crisis and nervousness, it's usually a good opportunity to start to invest, and when the sentiment does turn around, you will make decent profits. So I wouldn't liken it to that at all. I think it is a serious problem, but it's not a financial problem, and I think that's a more positive thing. At the moment, money is flowing freely, and at the moment it's just going in one way, which is back out of emerging markets and equity markets generally. So that's not the same as a complete panic and people taking money out and wondering where to keep it and if it was safe even in the banks, which it is still as of now.
Right. Up till now, expectations are that US markets or the US economy may actually do well. Do you think if there we see downgrades coming in, there could be a problem for equity investment worldwide?
Well, I think the problems have already been discounted to a large extent. The US has had its growth. There are some concerns, obviously, if oil continues to fall, what the Fed will do and the effects on inflation in the US. So there are a lot of fundamental economic problems if oil prices and commodity prices still languish. But I think a lot of the panic selling, a lot of the investment money which had to go out of emerging markets and equity markets has already happened. The volatility you're seeing at the moment is the indecisiveness and the uncertainty which is prevailing in markets. That will this Chinese situation get worse? Will the other economies which are dependent on oil also suffer more? So there's a real divergence of opinion. It's not everyone is in doom and gloom. Obviously there's buying. You've seen domestic funds, for example, locally stepping in to buy. We've seen investors stepping in to buy. That does not mean that the markets can't slip. But at the current levels are around, let's say, 74, 7,500 on our own domestic markets, I think valuations are reasonable. And as always, you can never pick the bottom. So if you've got that sort of nervousness, then you can always hedge your portfolios. And investors who are sitting on cash, we have seen them coming in. But to try and predict exactly what's going to happen in the short term is very, very difficult, because there's just too much uncertainty, and this panic and nervousness is creating that volatility. So if you're a cautious person, stay on the sidelines and just wait for a few more days or a week or two, and better to go long or to go aggressively long in the markets and start buying again if we move above that 76, 76.50 levels with some decisiveness, and we just don't stay there for a day or two, but at least for a couple of days. At least that will show that in the short term, at least hopefully the worst is over.
Right. The point that you made, that we are at the lower end of the valuations as far as large caps are concerned. Earnings have been slightly difficult to predict. They have continuously seen downgrades. Assuming that we don't see downgrades coming in further, or broadly earnings come in line, markets are trading towards the lower end of the valuations that they should trade at, which means large caps should now do much better than mid caps and some of the other names that have rallied in 2015.
Well, they should do if the results are in line, as you say, but it's about sentiment. If there's no money coming in to buy the stocks, then stocks will languish. You saw the positive impact of Infosys results yesterday and the negative reaction to TCS's results the day before. So the market will clearly look to stocks which they feel are performing well on the fundamentals and which can have some future growth prospects. And you will see some churning of portfolios. So index heavyweights, yes, they are obviously very key, and that's where I think you've seen a lot of the domestic funds go. Mid caps, as always, when there's panic and uncertainty, will always fall more sharply. If a large cap is falling 5%, the mid caps will fall anywhere between 10 to 15%. That's always been the case, and the same happens on the upside. So results obviously very, very important, but it is about sentiment, and sentiment at the moment is extremely weak. Most traders would be on the short side if you're following any systems or any trend levels, and you would probably look to short if there's any bounce back. Unless we stay about 100, 150 points higher on the Nifty, I think most people will use these opportunities as an opportunity to lighten up or go fresh on the short side. So it's very, very difficult. It's a difficult time for investors. But if you're patient and you can accumulate and you're not too much invested, then certainly you're getting decent companies at decent valuations. And as always, when you can start to accumulate, if you have a 6-month to a 1-year time frame, normally that shows that you will make some decent profits.
Right. Last few days, we've seen correction in the mid-cap space, which has not recovered as much as Nifty or probably what the large caps have done. You think there was a lot of froth over there and that needs to clear down for better flow in the market?
I think it's also the case that there was a lot of profits in mid-cap stocks. There are so many, but if I look at some of the holdings we may have had, a lot of the stocks have run up quite sharply. So when you're suffering losses in other stocks or you just want to lighten up, you will hit the sell button on some of those mid-caps. And a relatively smaller amount of quantity will take those prices down. You've seen some of them correct very sharply over the last few days. When the markets tried to bounce back yesterday, they did also try and bounce back. But I think it's a case also of people just taking some profits out. It's not a case that all mid-caps have suddenly turned bad and the fundamentals have just gone bad. It's just a case of people lightening up and looking to exit profitable positions to offset some of the losses they may have made in other large caps or even other smaller caps or mid-caps. So I think it's very, very stock specific. So don't look at the whole mid-cap pack as a general reason for the panic across the board.
Right. As far as domestic flows are concerned, now that the returns have not been that great, we've seen a sharp meltdown coming in. You expect the inflows to slightly slow down. December, we saw inflows half in the mutual fund industry. You expect it to see a further slowdown?
It's difficult to predict. Again, the clients and investors I've spoken to are quite optimistic. They're bullish. They're looking to put in reasonably large amounts, whether through the direct equity route or through mutual funds. So again, it depends on your perspective. The psychology is always that when things are going up, people are more bullish and enthusiastic to buy. And when things are negative and there's that fear factor, people are more reluctant. But anyone who's in a SIP should remain invested. This is a great opportunity for them to keep buying the mutual funds or stocks. Even if the markets fall another 5-10%, they should be happy if they've got a 3 to 5 year sort of time perspective. So I think it's, again, a very, very individualistic thing. Those who are patient and can see that the Indian economy, after 3 months, 6 months or 1 year will turn around, should not really stop their investment decisions. Yes, they may not put all of it in today, but certainly you don't stop the whole plan, because equity markets are volatile by nature. And it's at times like this when things are down and on the lower side that is actually a better time to start fresh inflows. But you've seen the figures from the DIIs, they're bullish, they're buying, and that's always been the case. The 7,500 level is a time where they seem to step in. The unknown factor is obviously the Chinese and the global economy. If that situation was resolved or calmed down, then I think you would see the Indian markets peak up quite sharply, because we do look quite oversold at the moment.
Right. Any risk on rally, as India, you said, is one of the most preferred market, would see the best returns?
Well, it will happen at some stage, but the thing is, you don't know if it's going to happen from 7,400 to 7,800, or it'll start at 7,200 back to 7,600 levels. So again, that's the uncertainty. As a trader, we're on the short side, unfortunately, because the trends are all pointing downwards. On the investment side, we're looking to accumulate. And you've seen that even stocks like Reliance, which had a very bad run, are showing some strength. TCS, some of the banks, they've corrected quite sharply, but HDFC Bank, even State Bank below 200 to me looks like a good investor's buy. So you'll always see some decent stocks, and a relief rally can come, but we just need 1 or 2 days of stability and the markets just to not have that volatility. So long as this volatility remains, it's difficult to see that risk-on rally sustaining for more than a day or two until that nervousness comes out of the system.
Right. Let's talk about some results. What do you make of Infosys results? You think Infosys will now lead the pack going ahead if IT has to perform from here on?
Well, the market's already expecting that, and the re-ratings have already happened. It's outperformed TCS. TCS was the leader for the last few years. TCS, when Infosys was underperforming, they've swapped positions, and TCS seems to be on the sell side, and Infosys clearly on the buy side. So the markets are clearly reacting to the results and the future prospects of the company. So yes, TCS, even at 2250, from our perspective, again, is a decent time to accumulate, but Infosys should be an outperformer over the next couple of quarters, and you will see targets ranging from 10 to 15% higher from the current levels.
Right. What do you make of names like private banks like Axis and ICICI? Very sharp sell-off that you've seen into these names. Is it a buying opportunity, or you would wait for a couple of results, management commentary that comes in from these names before taking any bet on these corporate private lenders?
Well, very disappointing stock performances from these banks, but again, at the current prices, I think it's a decent time to start to accumulate, especially ICICI. Axis has had some issues, but you've seen stocks like IndusInd Bank in the private sector perform well. As I mentioned earlier, HDFC Bank, it's maybe 5-6% off its highs, not much. It's fallen, but it does bounce back. So if you're allocating funds to private banks, our picks would be HDFC Bank, IndusInd, and then even stocks like Yes Bank, Axis, and ICICI. You can't time the cycle again in banking, but these are good fundamental stocks, and if you do accumulate with a 6-month to 1-year time frame, I'm sure as the crisis settles down and nerves calm down, you will see that the valuations are reasonable and a lot of buying interest will come back into these stocks, and you have the potential for a 20% sort of upside.
Right. As far as the overall issue about corporate asset quality is concerned, you think it's slightly overdone? Whatever is known probably tells us that we are in and around the peak of asset quality issues?
I should think so. I think, especially with the way the RBI governor is now trying to tackle all these issues as well, that there's no place to hide now. So I think, again, all the negative news to a large extent has been factored in. There's always a possibility of some unknown event resulting in a problem, but the key concern is, again, if commodity prices and certain sectors start to take a hit, then asset qualities again could be adversely impacted. So as of now, yes, it's factored in, but if there's a further negative news flow on the global front, then things will be relooked at. And again, that's creating the confusion and the uncertainty. When we have talk of oil slipping to $10 to $20, that uncertainty is still clearly there. And even at $30, most people would have thought it's a great buy, but still there's more people bearish than positive. So these knock-on effects will continue, and then re-ratings will happen. So it's going to be a very difficult and uncertain period, I think, for at least for the next month or two.
Right. HUL would be declaring numbers. You think Q3 is important because it should be the peak of winter season and peak of a couple of their portfolios in personal care to do well. If we see a slowdown over there, there could be a derating in HUL?
Well, HUL are obviously important for the market sentiment as a heavyweight. The expectations aren't too high, so anything on the positive, I think the markets would just accept as just a bit of a relief. So it is crucial that the results are pretty decent. The main thing is that the management talk is not negative and not talking about a further slowdown. But I think, again, at the 820 levels, it's fair value, it's reasonable, it's not cheap, it's not expensive, and it's not underperformed the markets as a lot of other stocks have. So important more from sentiment perspective and as a heavyweight, but not so much for the overall health of the markets, as there are a lot of other sectors and a lot of other stocks which the market would be more keenly focused on.
Right. Sajiv, thank you so much for taking out time for us. Always a pleasure talking to you.